$1,000 gone in 4 hours. Not a bad trade gone wrong, not a crash, just a normal Tuesday afternoon in zero DTE options. That's what we're talking about today. Hey, what's up? Welcome back to Chalk Talks with Coach B. Today we're getting into one of the most searched, most hyped, and honestly most dangerous corners of the options market, 0 days to expiration or zero DTE. If you're brand new to options and you haven't gone through the basics playlist yet, go check that out first, because this episode assumes you already know what a call option is, what a premium is, and how expiration works. Linked in the description. And as always, drop your questions in the comments or come find me on the stream. All right, let's get into it. Here's the one sentence definition. A zero DTE option is a contract that expires today, same day you're trading it. That's it. The clock runs out at market close. Now, on the surface, that sounds exciting. Quick in, quick out, no overnight risk. And that's exactly why retail traders love them. But what sounds like speed is actually a trap if you don't understand what's happening underneath. Let me show you. So the pitch for DTE goes something like this. The premiums are cheap. You can buy a call for $1. That's $100 for one contract. And if the stock makes a big move today, that contract could be worth $5 or $10 by the afternoon. Your $100 turns into $500. 5 times your money in a single session. That does happen. I'm not going to pretend it doesn't. But here's what the highlight reel leaves out. The reason DTE moves so fast in both directions is a Greek called gamma. Gamma measures how quickly an option's delta, its sensitivity to the stock price, changes. And when you're at expiration, gamma is at its highest. A tiny move in the stock can completely flip the value of your contract, up or down. So yes, gamma can make you money fast, but gamma also destroys your position just as fast if the stock doesn't cooperate. And when you're in a zero DTE option, there is no time to recover. And then there's theta, time decay. Every day an option exists, it loses a little value just from time passing. In a regular 30 or 45 day option, that decay is gradual. In a zero DTE, you don't have days, you have hours, you have minutes. That decay curve is almost vertical in the last 2 hours of the session. Even if the stock goes sideways, not down, just sideways, your option is bleeding to zero the entire time. Okay, let's walk through the actual numbers. So this is concrete. Say a stock I'm watching is at $100 at the open. I think it's going to break out today, so I buy a DTE $102 call for $1, one contract. That's $100 out of my pocket. For that call to be worth anything at close, the stock needs to be above 102. That's a 2% move in a single day. Not guaranteed, not even likely on a random Tuesday. Instead, what happens is this. The stock chops around, dips a little at 10:30, recovers by noon, and then just drifts sideways into the close. It never reaches 102. At 4 o'clock, that contract expires worthless, $100 gone, and the stock barely moved. That is the DTE experience for most beginners. The market didn't crash, no bad news hit. The stock just didn't move enough, fast enough in the right direction, and time took care of the rest. Here's the part I really want you to sit with. When you buy a DTE option, you're fighting on 3 fronts at once. You need the stock to move in the right direction. You need it to move far enough to clear your strike, and you need it to do all of that before 4 o'clock today. Miss any one of those 3 conditions, and you lose. All of it. That's not how most option strategies work. When you sell a covered call 45 days out, time is working for you. In a DTE buy, time is your enemy from the moment you enter. Now, some of you are going to try it anyway. I get it. I'm not going to tell you never do it. But if you insist on experimenting with DTE, here's the one rule I'd put above everything else. Size tiny. We're talking one contract. $100 of risk, not 1,000, not 500. One contract. The reason is simple. You will lose on most of them while you're learning. That's not pessimism. That's just math. So make sure losing on most of them doesn't actually damage your account. A $100 loss on a $5,000 account is a tuition payment. A $1,000 loss is a setback. The smarter move when you're starting out is to go further out in time. If you like a setup on a stock, buy a call or a put that's 30 to 45 days out. You're giving the trade room to breathe. Theta is working slowly. A small adverse move doesn't immediately wipe you out. Zero DTE is a tool for experienced traders who can read intraday momentum, who know when to cut a losing position within minutes, and who can stay disciplined under pressure. Most beginners are still building those skills, and you can't build them if you're blowing up your account in the meantime. So here's what I want you to walk away with today. Zero DTE is not a cheat code. It's not a shortcut. The premiums are cheap because the odds are brutally short. Gamma and theta are both working against the buyer, and if you don't know exactly what you're doing, that combination will empty your account faster than almost anything else in the market. $1,000 to zero in 4 hours. Normal afternoon. That's the risk. Quick reminder, this is education, not financial advice. I'm not telling you to buy or sell anything. Do your own research. That's it for today. If this helped, hit the like and subscribe, and leave me a comment. Let me know what strategy you want me to break down next. Good luck in the markets, no matter what stock you're into.